All right. We've been keeping a close eye on those CPI numbers, right? And, well, today's release, I'm telling you, it kind of threw us all for a loop.
Didn't it? You've been really good about tracking the recent downtrend, and honestly, most analysts were expecting more of the same.
Yeah, more the same.
But today's numbers, well, let's just say they had other plans.
Exactly. Which is why we've got Michael Edward Perinotti with us today. He's an award-winning hedge fund trader over at True Trading Group.
And if anyone can help us unpack this, it's him. Especially, considering he navigated the 2008 crisis. That's some serious experience right
For
there.
sure. So, what's caught his eye in all of this?
Well, he's really zeroed in on the fact that both headline and core CPI came in, well, hotter than expected. We're talking 2.4% year over year for the headline number. And remember, that includes things like your food and energy prices.
Higher than the 2.3% a lot of analysts were predicting.
Right. And even those seemingly small differences, those tenths of a percentage point,
Yeah.
they can really shake things up in the market.
Wow. Okay, so that's headline CPI. But what about core CPI? What are we seeing there?
Even hotter, actually. 3.3% year over year. And remember, core CPI strips out those more volatile prices like food and energy to give us a clearer picture of the underlying trend.
So this isn't just about, gas prices going up or anything like that. It's a lot broader. I can see why everyone's really interested in what Perinotti has to say.
Yeah, he's really emphasizing how this CPI data, especially when you consider last month's strong jobs report, well, it really suggests that the economy is much more resilient than a lot of people thought. And, that has some pretty significant implications.
Especially when you think about the Fed's upcoming rate cut decision. I mean, everyone and their mother was expecting a 50 basis point cut, right?
Yeah. Pretty much a sure thing, at least that's what it seemed like. But Perinotti really highlights how even the tiniest change, like a tenth of a percentage point or a basis point, as they say on Wall Street, can have, well, a ripple effect. He actually thinks the market might be leaning more towards a smaller cut, maybe 25 basis points instead of 50.
Oh, wow. So potentially less economic stimulus than everyone initially thought. That's a big deal.
Definitely. And while the overall market might not, freak out immediately, Perinotti is particularly interested in seeing how this impacts certain sectors. He specifically mentioned solar energy.
Oh, interesting. Why solar companies in particular?
Their business models, they're really sensitive to interest rates. Those big solar projects, they require a lot of financing, you see.
Yeah, of course. So if borrowing money becomes more expensive because of this potential shift in rate cut expectations.
Exactly. Projects could become less profitable and investors, well, let's just say they might get a little spooked. It really shows you why understanding these indicators can be such a game changer.
Yeah, it's about anticipating those chain reactions before they even happen.
Exactly. Some investors, well, let's just say this CPI data might have caught them off guard. But others, they were ready. They anticipated this impact on interest rate sensitive sectors and made adjustments to their portfolios.
Wow, that's fascinating. So, should we be hitting the panic button? Is this a sign that, inflation is back with a vengeance?
That is the million-dollar question, isn't it? And this is where Perinotti's insight becomes even more, well, intriguing. Right now, he argues, investors seem to be more focused on the bigger picture, the overall health of the economy.
So that strong jobs report we talked about earlier, that's still a major factor.
Exactly. It's like this tug of war, you see. Potential inflation on one side, a very robust job market on the other.
And just to make things even more interesting, we've got earnings season coming up.
Oh, and this upcoming earnings season. That's going to be crucial, according to Perinotti. Oh, yeah, and here's why. Well, it all comes down to valuations. Companies in the S&P 500, those top 500 companies we always talk about, they're trading at, well, a pretty high price-to-earnings ratio right now.
And, we always keep an eye on those price to earnings ratios, but I mean, with the S&P already so high.
It means investors are basically, they're already betting on big growth, They're expecting companies to keep knocking it out of the park. But if those earnings reports come in and they're not so great,
Yeah, if they don't meet those expectations.
well, then reality comes crashing down, doesn't it? And the market. It doesn't handle those surprises very well.
Not well at all.
So yeah, these upcoming earnings reports, they're going to be, well, they're going to be big. Companies really need to deliver. They got to justify those high valuations. Otherwise, well, we could see some market corrections.
Meaning things could go down.
They could, yeah. It's
Yeah.
all this balancing act, right? Economic indicators, like this CPI data, company performance, what investors are feeling, it can get pretty complex.
It sounds like it. But Perinotti, he seems to have a real knack for navigating this kind of stuff.
He does, yeah. And what he's really stressing right now is that this CPI data, it's important, don't get me wrong, but it's just one piece of the puzzle. We really need to see how it all fits together with these other factors.
And earnings season, that's going to give us a much clearer picture of, well, of how companies are dealing with all of this. The inflation, these potential slower rate cuts, the whole economic climate.
Okay.
So while these CPI numbers are definitely something to pay attention to, it's important not to get too caught up in the short-term ups and downs.
Right, exactly. Remember what Perinotti said. One data point doesn't necessarily mean we've got a full-blown trend on our hands,
This is where having someone like Perinotti in your corner would be, well, pretty amazing.
wouldn't it? But even without having your own personal hedge fund manager on speed dial, you can still,
Hmm.
you can still learn from his approach.
Yeah, for sure. So for our listener who's out there, taking notes right now, what are the key takeaways? What should they be really focusing on in the coming weeks?
Well, first and foremost, and I know you've heard this before, but it's true, knowledge is power. The
Hmm.
more you understand about these economic indicators like CPI
Yeah.
and how they can impact things, the better prepared you'll be to make smart decisions.
It's like having that secret decoder ring to make sense of all the financial news.
Exactly. And second, you got to keep that long-term perspective. Don't let the daily ups and downs, the noise, throw you off course. Remember what Perinotti said? The CPI data, it's just one piece of a much bigger picture.
Yeah, no, it's true. Easier said than done sometimes, though, right? When you've got those headlines, those flashing red lights screaming about inflation.
It can be, yeah. But zooming out, focusing on the bigger picture, the long game, it
Yeah,
really is key.
absolutely. What else should our listener be keeping in mind?
Well, Perinotti, he's really hammering home the importance of this upcoming earnings season. That's what he's laser focused on right now. Keep a really close eye on those reports, especially for companies in those sectors we talked about, the ones that are really sensitive to interest rate changes, like solar.
Right, because that's where we'll really see how these broader economic trends, how they're actually playing out on the ground, the real world impact, not just the theory.
Exactly. And don't just look at the numbers themselves. Pay close attention to what the companies are saying, their guidance. Are they optimistic about the future? Are they factoring in these potential rate changes? Those earnings calls, they can be incredibly revealing.
It's like getting that little glimpse behind the curtain, right? Seeing how the sausage gets made.
Exactly. And finally, remember that economic conditions, they can change on a dime. We saw that today with this CPI data. What seemed like a sure thing a few weeks ago, well, not so much anymore.
No crystal ball, unfortunately. No way to predict the future with 100% certainty.
Nope. But by staying informed, really understanding what these indicators are telling us, keeping that long-term perspective and paying attention to those earnings reports, you're going to be in a much better position to navigate whatever comes next.
Well said. Knowledge is power, right?
Oh.
And a big thank you to Michael Edward Perinotti for lending his expertise to our deep dive today. For our listener, keep those eyes peeled for those earnings reports, keep asking those smart questions, and until next time, happy investing.